Hey there, crypto enthusiasts! Welcome back to our channel, where we break down the latest in the world of cryptocurrencies and trading. Today, we're diving into a fascinating topic that's gaining traction in the crypto trading space: perpetual futures. Whether you're a seasoned trader or just starting your journey into the crypto universe, understanding perpetual futures can significantly enhance your trading strategy. So, let's get right into it. But first, what exactly are perpetual futures, and how do they differ from traditional futures contracts? That's a great question. Let's unpack this concept together. To understand perpetual futures, we need to start with the basics of futures contracts. A futures contract is a legal agreement to buy or sell an asset at a predetermined price at a specific time in the future. These contracts are commonly used in traditional markets, such as commodities and stocks, to hedge against price fluctuations or speculate on price movements. For instance, let's say you're a wheat farmer and you're worried that the price of wheat might drop by the time you harvest your crop. You could enter a futures contract to sell your wheat at today's price, ensuring that you won't lose money if the price falls later. However, once that contract expires, you need to settle it either by delivering the asset or settling in cash. Now, this is where perpetual futures come into play. Unlike traditional futures contracts, perpetual futures don't have an expiration date. This means that traders can hold their positions indefinitely, as long as they maintain sufficient margin. Perpetual futures are often used in the cryptocurrency market, where volatility can lead to rapid price changes. For example, let's say you believe Bitcoin is going to rise in value. You decide to buy a perpetual futures contract. If Bitcoin's price increases, your position becomes more valuable, and you can close it for a profit whenever you want. Conversely, if the price falls, you're required to maintain your margin. If your account balance falls below a certain threshold, you may face liquidation. One of the key features of perpetual futures is the funding rate mechanism. This is a periodic payment exchange between long and short positions to ensure that the price of the perpetual contract aligns closely with the spot price of the underlying asset. For instance, if there are more traders holding long positions than short positions, the funding rate might be positive, meaning that long position holders pay short position holders. This keeps the market balanced. Conversely, if there are more short positions, the funding rate becomes negative and short traders will pay long traders. This mechanism encourages traders to open positions in the opposite direction if the market becomes too skewed. So, why should you consider trading perpetual futures? Here are a few benefits. You can hold your positions for as long as you believe in the market trend without worrying about a contract expiry. Many exchanges offer high leverage on perpetual futures. This means you can control a larger position with a smaller amount of capital. For instance, with 10x leverage, you can control $10,000 worth of Bitcoin with just $1,000. However, remember that while leverage can amplify your profits, it can also magnify your losses. Unlike traditional futures markets that have set trading hours, perpetual futures can be traded around the clock. This is particularly advantageous in the fast-paced crypto market, where prices can change rapidly. Perpetual futures allow traders to hedge against potential losses in their spot holdings. If you own Bitcoin and fear a short-term decline, you can take a short position in perpetual futures to offset potential losses. Of course, it's essential to be aware of the risks involved in trading perpetual futures. Cryptocurrencies are notoriously volatile, meaning that prices can swing dramatically in a short period. This volatility can lead to significant profit opportunities, but it also increases the risk of losses. If the market moves against your position and your margin falls below the required level, your position might be liquidated. This means you could lose your entire investment. Understanding how perpetual futures work, including the funding rate and leverage, can be more complex than trading spot markets. It's crucial to educate yourself before diving in. To sum it up, perpetual futures provide a flexible and unique way to trade cryptocurrencies, allowing you to speculate on price movements without the pressure of an expiration date. With benefits like leverage, continuous trading, and hedging opportunities, they can be a powerful tool in your trading arsenal. But remember, with great power comes great responsibility. Always be mindful of the risks involved. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and hit that notification bell so you never miss an update. Have questions about perpetual futures or topics you'd like us to cover next? Drop a comment below. I'd love to hear from you. Until next time, happy trading and stay informed.